I remember talking to people who before COVID or during COVID could borrow like 800, 900,000. They sort of went quiet for a couple of years, came back to me, and after all these rate hikes, they could only borrow $480 to $500,000. It was pretty savage. Equally, on the other side of the coin, when rates start to drop, borrowing capacity increases again, making it easy to qualify for larger loans. For existing homeowners, higher interest rates obviously mean you need to allocate more income to mortgage repayments. This can squeeze your budget, which means you have to cut back on other expenses to cover the larger mortgage repayments. If you're a first home buyer, high interest rates can be a bit of a double-edged sword. You might not be able to borrow as much, and higher payments can be daunting. At the same time, higher interest rates can cool down hotter property prices. When borrowing is more expensive, fewer people can afford to take out big loans, which slows down demand for homes. Historically, we've seen some cases where house prices can stagnate or dip with higher interest rates, which could make it more affordable for you as a first home buyer. There's also a bit of a silver lining if you're still trying to save a deposit. If there are higher interest rates, you obviously get higher savings accounts, but as interest rates come down, your savings accounts are going to get slashed as well. So to sum up, the Reserve Bank cash rate and your home loan interest rate are pretty tightly linked. When the cash rate changes, your variable home loan, or even your savings account actually, changes as well pretty shortly thereafter. Specifically with the home loan though, it's going to affect your mortgage repayments. Higher cash rate equals higher home loan rates equals higher repayments and lower borrowing capacity. A lower cash rate equals lower home loan rates, lower repayments, and also high borrowing capacity. So now it probably makes sense why the next Reserve Bank cash rate announcement can affect you in the future. Which brings me to my next question. If the Reserve Bank's cash rate and home loan rates are so connected, why is it sometimes that the banks don't pass on the full rate cut or hike? In other words, why is it that banks don't always mirror the RBA's moves? Let's go through that. If the cash rate and home loan rates are so closely linked, you might wonder why sometimes the banks don't exactly follow the RBA's moves. For instance, you might have seen in the news, the Reserve Bank's cut the cash rate. Most of the banks are passing on the rate cut in the full 0.25%, but there are some that are passing on none at all. There's some only passing on 0.15, like partially, and you might be wondering what's going on here. The key thing to remember is that while the Reserve Bank's cash rate heavily influences the bank's interest rate costs, banks can ultimately set their own rates based on a variety of factors. They're not legally required to match Reserve Bank's cash rate one for one, though there's often a lot of public and political pressure to do so. Essentially, it's up to them when it comes to the cuts or hikes.